A bill sitting in Congress right now could add a flat 3.5% tax on every dollar you wire abroad. That means the next time you send $500 home, you lose $1,750 before it even arrives. Send $1,000, you lose $35. Do that once a month, and you're out over $400 a year. Gone, not to the person you're trying to help, to the federal government. This video explains exactly what the bill says, who it hits, how the math works, and, at the end, what some people in this situation are doing right now to protect what they send. This is for educational purposes only, not financial advice. The bill is called the REMIT Act. It stands for Remittance Excise on Money Intended for Transfer. Representative María Elvira Salazar introduced it in the House. The version currently in discussion targets the 2026 fiscal calendar, which means if it moves, the clock is already running. Here's why this matters more than most people realize. Remittances from the United States are one of the largest cross-border cash flows on the planet. In 2023, the World Bank estimated that migrants sent roughly $150 billion out of the United States. $150 billion. That's not a rounding error. That's a pillar of entire national economies, from Mexico to the Philippines to El Salvador to Nigeria. And the people sending that money are not wealthy. The typical remittance sender earns a modest wage, sends somewhere between $200 and $1,000 at a time, and does it regularly, sometimes every 2 weeks, because someone back home depends on it. So when a bill targets that transfer, it is not hitting a financial product most people have heard of. It is hitting a kitchen table decision. Do I send rent money to my mother this week? Or do I absorb the tax? Now, a key detail. The bill, as written, applies to transfers made by non-citizens. That includes green card holders, work visa holders, students on visas, and undocumented individuals. If you are a U.S. citizen sending money abroad, the current draft does not apply to you. But here is the thing. The bill's language has shifted in different versions, and some proposals have included broader definitions of who qualifies. That ambiguity is exactly why this story is worth watching closely. Which brings up a question a lot of people are sitting with right now. How did we get to a point where the act of sending your own money is treated as a taxable event? Drop your answer in the comments. Do you currently send money abroad? And how often? It helps us understand exactly who needs this breakdown most. Here's the mechanism, because this is where most coverage gets lazy. A remittance excise tax is not an income tax. It does not touch your paycheck. It is a transaction tax, meaning it triggers at the moment of transfer. Think of it like a sales tax on the act of sending. Every time you initiate a wire, the tax applies to the full amount you send before fees. The proposed rate in the REMIT Act is 3.5%. That sounds small. Here is what it actually means in a year. If you send $300 twice a month, that is $7,200 a year. 3.5% of $7,200 is $252. That is money that was supposed to feed someone. It is now a federal tax line. If you send $500 twice a month, you're sending $12,000 a year. The tax on that is $420 every single year, and those numbers assume the rate stays at 3.5%. There have been versions of similar proposals that floated rates as high as 5%. At 5% on $12,000, you lose $600 a year. Now here is the angle most outlets are not covering. The tax compounds with existing transfer fees. Right now, services like Western Union, MoneyGram, Remitly, and Wise all charge their own fees, which can run from 1% to 7%, depending on the corridor and the amount. Add a 3.5% federal excise tax on top of that, and the total cost of sending money can push toward 10 or 11% of the transfer. For a family living on remittances, that is not a minor friction. That is a structural cut in their income. This is what I'd call a hidden stack tax. The government's cut sits invisibly on top of a fee infrastructure the sender was already navigating. It does not show up as one visible charge. It shows up as less money arriving. If this changed how you think about what a simple money transfer actually costs, that's exactly what we break down here every week. One story like this, built for people still building wealth, not people who already have it. Subscribe if you want the next one. Here is the second angle, and this one is important. The bill has political momentum because it is tied to a broader immigration enforcement argument. The framing from supporters is that taxing remittances discourages illegal immigration by reducing the financial incentive to work in the United States and send money home. Whether you agree with that framing or not, it changes how you read the legislative risk. Bills attached to immigration politics in this environment move faster than standalone fiscal proposals. That is not an opinion. That is how Washington has worked for the past several years. The REMIT Act is not just a tax bill. It is also a political signal, and political signals in Congress get pushed harder and faster than neutral budget items. There is also a legal dimension worth naming. The United States does not have a broad history of transaction taxes on personal remittances at the federal level. Most excise taxes in U.S. law target goods like gasoline or alcohol or airline tickets under the Internal Revenue Code. A remittance excise would be a relatively novel application of that framework. Legal scholars have raised questions about equal protection challenges, specifically the fact that the tax as drafted applies only to non-citizens. That is a significant constitutional question, and it means even if the bill passes, it could face court challenges that slow or alter its implementation. But banking on a legal challenge is not a financial plan. That is a hope. One more mechanism to understand. The collection point. Under the bill, the tax would be collected at the point of transfer, meaning the remittance service, Western Union, Remitly, Wise, your bank's wire department, would withhold 3.5% and remit it to the IRS. You would not file a separate form. The cost would be deducted automatically, which means the only way you would even notice it is if you read your transfer receipt very carefully. Most people don't, and that automatic deduction is exactly the part that creates the most risk for regular senders. Because if you are on a fixed schedule, sending every 1st and 15th of the month, the tax just becomes invisible friction. You adjust your life to absorb it and never consciously decide whether you want to. That is not an accident of policy design. That is how transaction taxes sustain themselves politically. They disappear into the background. So, what is the current status? As of the most recent public record, the REMIT Act has been introduced and referred to the House Ways and Means Committee. It has not passed the full House, and it has not moved through the Senate. But Ways and Means is the committee that controls tax legislation in the House. That is not a dead committee. That is where tax law is made. There are also signals that elements of the bill could be attached as a pay-for to a larger piece of fiscal legislation, meaning it might not move as a standalone bill, but as a rider on something that has to pass. That is the version that catches people off guard. So what are some people in this situation actually doing? Here are 2 concrete things worth knowing. The first is locking in transfer habits before any effective date. If the bill passes with a 2026 effective date, transfers made before that date are not subject to the tax. Some people who send large, irregular amounts, say for a family home repair or medical expense, are considering accelerating those transfers if the bill advances significantly. This is not about panic. It is about paying attention to the legislative calendar. Watch for a committee vote or a floor vote in the House. Those are the 2 signals that matter. The second is understanding which services would be most affected. Cryptocurrency transfers and informal cash networks are not currently captured by the bill's language as written, but relying on those carries its own legal and security risks that are separate from the tax question. The more practical point is this: not all remittance corridors are equally affected by fees. Using a lower fee service like Wise or Remitly instead of a legacy provider like Western Union already saves some senders between $30 and $90 a year on fees alone, depending on the corridor. If the excise tax passes, the total cost of every transfer goes up, which means the fee differential between services matters even more. Shopping your transfer service is not a complicated move. It is arithmetic. Some people are also asking whether sending larger, less frequent transfers would reduce the total tax hit. The answer is no. Because the tax is a flat percentage of the total amount, not a flat fee per transaction, the total tax owed is identical whether you send $12,000 in one wire or in 24 smaller transfers. The only thing that changes is the per transfer fee from the service itself, which may favor larger transfers. But the excise math is the same. Here's a real question for you. If this tax passed tomorrow, would it change how much you send, how often you send, or would you just absorb it? Tell me below. Seriously, The answers to that question tell us more about financial pressure on real households than most economic reports ever do. The REMIT Act is not law yet, but it is real, it is moving, and the people it would hit the hardest are the ones least likely to see it coming. You've now seen the exact math, the mechanism, the legal risk, and 2 moves worth knowing. Next on the channel, wire transfer fees, the ones already draining every international payment, and the 3 services that actually charge the least for the most common corridors. It's already up.